Well, good morning. Welcome back to Coffee and Cash in 2022. Tough to believe that we've been doing these videos for almost 2 years now. We started in February of 2020, not even really thinking or expecting for COVID to happen, but it's been a really great way for us to stay in touch with clients and hopefully answer a lot of important questions that you've been thinking about and answering. Thank you for your support of these videos, your feedback, your suggestion of questions over the last 2 years. We really value that. Please continue to make suggestions. We want to know what's on your mind and what you find helpful. So as you probably know by now, the first video of each month, we're generally going to do a market kind of update. And really the intention is not a more traditional kind of boring, this is what the stock market did type of update, but more kind of, major headlines that we've observed, interesting stories that we've come across from the previous month. As I kind of thought about today's video, I was thinking what would probably be most helpful is to kind of give you a little bit of a foreshadowing of what we see and what we expect to be the major themes and trends for 2022. And I really think that there's two major questions this year that you're going to be hearing about a lot. Quite frankly, that you've already heard about a lot in 2021, but ultimately I think are going to continue to be dominant themes. And so I want you to go into this year being informed and understanding why these two topics keep coming up and also how they interconnected and how they work together. So what are the two main questions, two main themes that we think are going to dominate markets for this year? Well, number one is the question of what happens with inflation. And the second question is really, what does the Fed do with rates, right? Let me take a moment, because inflation and interest rates are often spoken about in the same kind of sentence, in the same thought process, but I find very few clients really actually understand the relationship between these two things. They kind of understand inflation and they understand interest rates, but they don't always understand how they interact and how they play together. So let me give you a quick little kind of overview of that, because I think you're going to be hearing about this a whole lot in the coming months. So number one, inflation, right? Cost of living going up. We see it in various different ways throughout our life. You go to the grocery store. Even recently, my wife just told me that the dollar store is now basically charging $1.25 for everything that used to be $1. So that's an example of inflation, right? The cost of living going up and our dollar being worth less, right, over time. And that's kind of a natural progression of economic growth in many ways. So inflation is kind of easy to understand. It's been a major topic of conversation because ultimately, we've really seen it. We've experienced much higher inflation in the last 6 to 8 months than we really have over the last decade. So it's a little bit jarring when you've been used to 1 to 2% inflation, and now suddenly inflation's at 6, 7, 8, 9, 10% in some cases. So inflation, we can kind of get our head around. Interest rates, on the other hand, we kind of understand that the central bank is really the one that's in charge of setting short-term interest rates, and then a lot of other interest rates, for example, mortgages, car loan rates, et cetera, are kind of based off of those original rates that are set by the Federal Reserve. And so how do these two things interplay? Well, ultimately, interest rates are the primary tool that the Fed or the central bank has to tame inflation. They can do it in other ways, but the primary tool that the central bank uses to reduce inflation is to raise interest rates. So I want you to always remember that relationship. Inflation on one hand, interest rates on the other. If the central bank wants inflation to reduce, they raise rates. This has the effect of cooling down the economy. Think about in the effect of raising rates and then now mortgage rates go up, right? What does that do? It naturally cools off the housing market because it makes houses relatively less affordable than they were when rates were lower, right? So raising rates has the impact of reducing inflation over time. On the other hand, if you kind of want to encourage inflation, then ultimately, you might lower interest rates. And that's kind of where we've seen over the last number of rounds of what's called quantitative easing, is that ultimately rates have been reduced and lowered in order to try and stimulate the economy, to encourage borrowing, and to ultimately try and get inflation going, right? So always remember that relationship, that the main tool that the Fed has to fight inflation is to raise rates. So how is that important for 2022? Well, obviously, as we've looked at kind of the market performance over the last 18 months, stock markets, real estate, crypto, pretty much any asset has gone up dramatically in price, right? And a large part of that is a very accommodating interest rate environment, right? Interest rates have been extremely low, which has made it easier and more affordable to buy assets, and that tends to increase prices over time. So obviously what we're looking at is if we go back to that relationship between inflation and interest rates. In general, an investor doesn't really want interest rates to go up because ultimately then it can cool down the asset that they're buying, right? So all things being equal, interest rates lower are generally better for most investors. Obviously that excludes folks like, who have a lot of cash in the bank, who are earning zero interest at the current time. But in general, rates lower equal higher asset prices. And so the main concern is that although the Fed has said that they expect to leave rates low for an extended period of time, that they project maybe 1 to 2 interest rate hikes this year, the main concern is that if inflation remains too high for too long, that ultimately the Fed's hand may be forced, that they may be forced to raise inflation sooner than they otherwise maybe want to. And this, again, raising rates could certainly cool off the economy, reduce asset prices, whether it's housing, whether it's stocks, markets, et cetera, et cetera. So that's the main, I think, theme and relationship to keep in mind, that if inflation stays too high for too long, the Fed will likely be forced to raise rates sooner and maybe more aggressively than they expect. And that certainly could spook the markets. So expect to hear those two things talked about significant amounts in the coming year, because I do think that even if you look at other issues like COVID, or maybe even additional stimulus measures like the Build Back Better bill, things like that, they matter to the market to the extent that they really impact inflation and interest rate expectations in many ways, right? So they're almost like secondary types of drivers of the economy and of the stock market currently. So, I think keep an eye on inflation, keep an eye on the Fed and interest rates, and obviously that's what we'll be doing on an active basis and trying to position portfolios to try and take advantage of certain environments. So for now, I'd say overarchingly, although we've just done a large rebalancing of our portfolios and a repositioning, we feel certainly still relatively comfortable in that growth still remains strong. Earning growth continues to be very, very good. The Fed is still accommodating. So even if they start raising rates, they're raising them from a very low base, right? So again, I think broadly speaking, we'll give the benefit of the doubt currently to the markets kind of being where they are, but we do recognize that there are significant risks. The market is expensive. Asset prices in general are expensive, and certainly if interest rates rise faster than expected, that could certainly do some damage in the market. So again, continuing our theme of not being complacent, right? Making sure that we're rebalancing, making sure our portfolios are still appropriate for the level of valuation risk that is currently in the market, I think is really, really important. There are a couple of other things that could really go right in the market this year, right? So if we think about things that could go wrong, and we spend a lot of time thinking about what could possibly go wrong, there's also certainly things that could go right and maybe better than expected. So I think if inflation peaks earlier than expected and maybe starts to turn the corner downwards earlier than expected, that could certainly help the markets, because again, it then relieves the pressure on the Fed to necessarily have to raise rates as quickly as maybe some market participants expect. So again, if the Fed doesn't tighten as much or as quickly, that would be a broad positive. If earnings remain very strong, that would be broadly positive. And certainly if COVID kind of starts to end and kind of burn out, not from a perspective of, the virus disappears, but more that we just kind of get more comfortable with living with it. I think that all of those types of things, we've seen the market reaction get progressively less of a knee-jerk reaction to virus developments as we've gotten vaccination rates up and things like that. So I think as we progress through 2022, it's likely that those types of themes are going to be less predominant, and that again, it will really be centering around the withdrawal of the support from the Fed that we've seen over the last 18 months. It's not unlike, kind of weaning a patient off their meds, right? the last 18 months, the economy and the stock market have been on pretty heavy meds. And now we have to kind of do those withdrawals and kind of assess and monitor how the patients or the markets respond in that way. So again, don't get complacent, continue to hold a balanced portfolio with things that will certainly hold up if things go badly. But we certainly appreciate your trust. As always, we're looking forward to another good year in 2022. As always, if we can be of any assistance, if you have any questions, please reach out. We'd love to set up time to talk you through your particular portfolio. But I do hope that overview of interest rates and the relationship to inflation was helpful, as I think that those are going to be pretty dominant trends in 2022. So thank you so much for watching. Looking forward to a great year of Coffee and Cash videos. Send in your suggestions for video topics. And if you found this helpful, feel free to like and share this video with friends. Thanks so much. Looking forward to talking to you next week. In the meantime, have a good one.